In 1998, the smartest hedge fund in history needed a bailout. Its founders included two Nobel Prize winners in economics, the men who literally wrote the mathematical formulas the entire financial industry uses to price risk. Its partners had a combined century of experience at the highest levels of Wall Street. Its model had never been wrong. In 6 weeks, they lost $4.6 billion. The Federal Reserve had to personally call the CEOs of every major bank in America and beg them to step in, because if they didn't, the entire global financial system was at risk of collapse. This is not a story about bad people or bad luck. It's a story about what happens when even the most brilliant minds in the world make one specific mistake. And that mistake, I promise you, is the same one most investors are making right now. John Meriwether ran the bond trading desk at Salomon Brothers in the 1980s. His team made more money than any other group on Wall Street. He didn't hire traders with gut instincts. He hired mathematicians and physicists with PhDs who treated markets like equations with solutions. In 1994, he left and started long-term capital management. He brought his best people. Then he recruited Robert Merton and Myron Scholes, the two economists who had developed the Black-Scholes model. That formula is what every options trader on earth uses to price derivatives. It won the Nobel Prize in 1997. These weren't merely smart people. They were the people who built the mathematical language that the entire industry runs on. Investors lined up. Minimum investment, $10 million. They raised $1.25 billion in year one. Then the model did exactly what it was supposed to. 1995, up 43%. 1996, up 41%. 1997, up 27%. 4 straight years of printing money. Wall Street started calling them the Dream Team, the people who had finally figured it out. At its peak, LTCM managed $125 billion in assets. The number that matters more, $1.25 trillion in open positions. For every dollar of investor money, they'd borrowed and deployed 100. That 100-to-1 ratio is the number that ends the story. The trades themselves were almost boring. Picture two nearly identical bonds, same government, same maturity, same credit rating. One issued 6 months ago, one issued last week. They should trade at the same price. They don't, not exactly. There's a tiny gap, a few hundredths of a percent. LTCM's model said that gap would close. It always did. So they buy the cheap bond, short the expensive one, and wait for prices to converge. The profit on any single trade was almost nothing. To make real money, you need scale, so they borrowed. A lot. A trade that makes 0.5% on your own capital makes 12.5% if you've borrowed 25 times that capital. Run that across thousands of simultaneous positions and suddenly you're posting 40% annual returns. The model said the risk was effectively zero. Not low, zero, because the trades were market neutral by design. If everything moved together, you'd lose on one side and gain on the other. What it couldn't account for was the one scenario it had never seen, a world where everyone tries to exit the same position simultaneously. That scenario had no historical data, so the model assigned it a probability of essentially nothing. It turned out to be the most expensive rounding error in financial history. In 1997, the Asian financial crisis hit. Thailand, South Korea, Indonesia, currencies collapsed, markets fell, the trades moved against LTCM. The model said, stay in. The gaps close. They always close. And they did. By early 1998, most positions had recovered. The Asian crisis passed and LTCM came out the other side intact. This is the part of the story where I'd ask you to slow down and notice what happened next. Surviving a crisis with your model intact doesn't mean the model was right. It might just mean you got lucky. But the human brain doesn't process got lucky cleanly, especially when you have a Nobel Prize and 4 years of data telling you you're a genius. So they drew the wrong lesson. Not, we survived, but we were right. The model held. We should have more of this. They added leverage, more positions, tighter spreads that required even more borrowed money to generate meaningful returns. By mid-1998, a fund that had once been disciplined about risk was essentially running one giant bet, that nothing truly unprecedented would ever happen. On Wall Street, that strategy had a name. Picking up nickels in front of a steamroller. Small, steady gains. One catastrophic loss. The steamroller was already moving. In 1997, JP Morgan's risk team modeled what would happen to their own firm if LTCM collapsed. They concluded the losses would be catastrophic. They told LTCM's response, their model showed the risk was negligible. J.P. Morgan was wrong. 12 months later, J.P. Morgan was sitting in that room at the Fed. August 17, 1998. Russia defaulted on its government debt. A major nuclear power defaulting on sovereign debt had no modern precedent. The model had no scenario for it because scenarios require historical data and this had none. When investors panic, they do one thing: sell everything risky and buy the safest asset they can find: U.S. Treasury bonds. LTCM's entire strategy rested on the gap between safe assets and slightly riskier ones closing over time. The Russian default didn't close that gap. It blew it open. The spread between treasuries and everything else hit levels the model called statistically impossible. Not unlikely. Impossible. In 1 month, LTCM lost $1.9 billion. Half their capital. Gone. And here's what makes this more than a story about Russia. The trades weren't wrong. The logic was still sound. Most of those positions eventually recovered exactly as predicted. After the crisis passed, the strategy worked. They just couldn't stay alive long enough for it to work. The Black-Scholes model assumes market volatility follows a normal statistical distribution. In August 1998, the movement's LTCM experience were 10 standard deviations from their predictions. That's supposed to happen once every several billion years. It happened in a single month. 6 weeks, that's all it took. As losses mounted, lenders demanded collateral, standard in leveraged finance. When positions lose value, banks want cash to cover the exposure. LTCM had to sell positions to raise it, but they were so large that selling made prices fall further, which triggered more margin calls, which forced more selling. Prices fell more. The spiral fed itself. And because every major bank on Wall Street had spent 4 years copying LTCM's trades, everyone could see what was working. Everyone wanted in. When LTCM started unwinding, every bank unwound the same positions at the same moment. The market for those assets essentially disappeared. By late September, LTCM had lost 90% of its value, $4.6 billion. Gone. Merriweather wrote a letter to investors. Careful, measured language. Reading between the lines, it said one thing: we don't know how to stop this. At the height of the crisis, senior Federal Reserve officials estimated a real possibility of complete seizure of global credit markets. Not a recession, a seizures, where lending stops entirely and the financial system locks up. 16 people in a Connecticut office park came that close. September 23, 1998, the Federal Reserve Bank of New York called an emergency meeting. A room, no press, no announcement. In that room, the CEOs of Goldman Sachs, Merrill Lynch, Morgan Stanley, J.P. Morgan, and 10 other major institutions. 14 firms total, people who had never sat in the same room for the same reason. William McDonough, president of the New York Fed, stood up and told them something that must have felt almost absurd to hear. He told them that LTCM, a fund most of their clients had never heard of, run by 16 people in a Connecticut office park, was about to take all of them down with it. That the positions LTCM held were so deeply embedded in global markets that a disorderly collapse would trigger simultaneous losses across every institution in that room. That none of them could exit cleanly. That the only path out was together. One CEO reportedly turned to the person next to him and asked, "How is it possible that 16 people in Greenwich could put the entire system at risk?" Nobody answered. The 14 firms put in $3.6 billion in exchange for a 90% stake in what remained of LTCM. Not to save Merriweather, because McDonough had made clear that the alternative was watching their own firms go down with him. LTCM was wound down over the next 2 years. Most of the trades came back. The analysis had been correct all along. They were right. They just ran out of time to be right. The popular story about LTCM is about arrogance, geniuses who got too confident, too greedy, and paid the price. That story is satisfying and mostly wrong. LTCM's strategy was sound. Their models were, and remain, among the most sophisticated ever built. Their read on the pricing gaps they traded was largely correct. Most of the positions that destroyed them in 1998 recovered exactly as predicted. Being wrong didn't kill them. Being unable to survive being temporarily wrong did. Leverage doesn't just amplify gains, it removes your ability to wait. Without leverage, a bad month is a bad month. You hold, the market comes back, you recover. With 100 to 1 leverage, a bad month is a margin call, a forced sale at exactly the wrong price, a spiral you can't stop. You liquidate a correct position at a catastrophic loss because you ran out of time. Keynes had a line for this: markets can stay irrational longer than you can stay solvent. LTCM proved it on a scale the world had never seen. During the crisis, Warren Buffett offered to buy LTCM's entire portfolio for $250 million. They turned him down. Those positions eventually recovered to roughly $3.5 billion. Buffett understood something LTCM didn't. The strategy was fine. You just needed to be able to wait for it. He could. They couldn't. You're not running $125 billion with 100 to 1 leverage, but the same mechanism operates at every scale, and it shows up in forms most people don't recognize as leverage. Buying on margin, borrowing to invest, keeping money in the market that you'll actually need in 18 months, concentrating everything in one stock because you're sure about it. All versions of the same trap, all ways of removing your ability to wait. And in investing, waiting is often the only real edge. When markets fall, and they always do, the investors who get hurt most aren't usually the ones who picked wrong. They're the ones who couldn't hold on, who needed the money at the wrong moment, who borrowed and couldn't meet the call. LTCM had better models, better data, more experience, more computing power than you'll ever have. None of it mattered when the crisis hit because they were forced to sell. The most important question in investing isn't am I right? It's can I survive being temporarily wrong? LTCM couldn't, and they were right. Invest only what you won't need for years. No leverage. Diversified. That combination lets you be wrong for a long time and still come out fine because the market does come back. It always has. You just need to still be holding when it does. The gap between being right and the market agreeing with you can be months, sometimes years. LTCM had 6 weeks. Don't give the market a reason to force you out before it agrees with you. After the bailout, Meriwether started a new fund, same strategy, lower leverage. It made money consistently for years and closed quietly in 2009 without incident. The strategy was never the problem. It never was. One question worth sitting with. Is there money in your portfolio right now that you'd be forced to sell if markets drop 30% tomorrow? Margin. Borrowed funds. Money you'll actually need in the next year or two. If the answer is yes, that's your leverage. Fix that before anything else. The strategy can be right. The timing can be right. If the structure forces you to sell at the bottom, none of it matters.